For decades, Americans were told the same advice again and again. If you can buy a home, you should buy it. Renting was seen as temporary, while ownership was seen as stability. But in 2026, that advice no longer fits reality. The cost of renting has surged, but the cost of owning a home has changed in ways most people didn't expect. Mortgage payments are no longer the biggest expense. Property taxes, insurance, maintenance, and long-term risk now play a much larger role in the decision. For many Americans today, renting offers flexibility but no equity, while buying offers stability but rising hidden costs. The real question in 2026 isn't whether renting is bad or owning is good. It's whether the old rules still apply. In this video, we break down how the rent versus buy decision has changed in the United States, what the numbers don't always show, and how to decide which option actually makes sense for your situation. For a long time, the advice to buy instead of rent made sense in the United States. Home prices generally rose steadily, mortgage rates were low, and ownership offered predictable costs. A fixed-rate mortgage meant payments stayed the same for decades, while rent almost always increased. Property taxes and insurance were present, but they grew slowly enough that most households could absorb them. For many families, buying a home was not just a place to live, it was a forced savings plan. Each payment built equity, and over time, that equity became security. This system worked especially well in an economy with stable wages, affordable insurance, and relatively low maintenance costs. Renting, on the other hand, offered flexibility but little long-term benefit. When people moved out, they left with no asset behind. In that environment, buying almost always won the long-term comparison. That's why the advice became universal and unquestioned. But that version of the housing market no longer exists in the same way. After 2020, the rent versus buy equation began to shift in ways most Americans didn't immediately notice. Home prices rose faster than incomes, and mortgage rates climbed to levels many buyers hadn't planned for. At the same time, costs that used to stay in the background moved to the front. Property taxes increased as local governments searched for revenue. Insurance premiums surged, driven by climate risk, rebuilding costs, and tighter underwriting. Maintenance became more expensive as labor and materials rose sharply. The result was a new reality. Owning a home no longer meant predictable long-term costs. Even fixed-rate mortgages couldn't protect homeowners from rising expenses outside the loan. Renting also changed, but differently. Rent climbed quickly in many markets, yet renters retained flexibility. They could move, downsize, or relocate without selling an asset. By the mid-2000s, many Americans found themselves choosing between two imperfect options. Buying now required higher upfront costs and ongoing risk, while renting meant accepting rising payments without equity. This is the turning point that makes the old advice unreliable in 2026. In 2026, renting in the United States looks very different from what it did a decade ago. Rents are higher, competition is tighter, and long-term stability is harder to find. In many cities, renters are paying more each month than homeowners who bought years earlier. Annual rent increases have become normal, not exceptional, and lease renewals often come with uncertainty. For renters, the biggest risk isn't just the price, it's predictability. A renter can budget for today's payment, but not always for next year's increase. At the same time, renting does offer something ownership often can't: flexibility. Renters can move for work, downsize when costs rise, or leave expensive markets without selling a property. There are no surprise repair bills, no property tax hikes, and no insurance shocks passed directly to the tenant. But there is a trade-off. Every payment goes toward housing only, not ownership. In 2026, renting has become a short-term safety valve for many Americans, but a long-term challenge for those hoping to build stability and wealth. In 2026, buying a home in the United States is no longer just about qualifying for a mortgage. Monthly payments are higher due to interest rates, but that's only part of the picture. Buyers now face larger down payments, higher closing costs, and stricter lending standards. Even after purchase, the financial pressure continues. Property taxes rise as home values adjust and local budgets expand. Insurance has become one of the fastest growing expenses, especially in areas exposed to storms, floods, or wildfires. Maintenance costs are higher than most buyers expect, driven by labor shortages and expensive materials. What makes buying riskier in 2026 is that many of these costs are unpredictable. A fixed-rate mortgage offers stability, but taxes, insurance, and repairs do not. For homeowners, affordability is no longer locked in at closing. It must be managed year after year. Buying still offers equity and long-term control, but it now requires stronger cash flow, deeper savings, and a longer commitment than it did in the past. In today's market, buying a home is less about timing the market and more about surviving the total cost of ownership. For years, the rent versus buy decision was simple. Renting meant higher long-term cost, buying meant long-term gain. In 2026, that comparison has shifted. Renting now costs more month to month, but buying carries more long-term risk. Renters face rising payments, but homeowners face rising obligations. The difference is where the risk sits. With renting, the risk is external. A landlord raises rent, and the renter decides whether to stay or leave. With ownership, the risk is internal. Taxes rise, insurance changes, repairs fail, and the homeowner must absorb the cost. This shift has changed how affordability works. In many markets, the monthly cost of owning is no longer dramatically lower than renting once all expenses are included. At the same time, the gap between best case and worst case outcomes for homeowners has widened. Some owners benefit from stability and appreciation. Others find themselves locked into a property that drains cash over time. In 2026, the rent versus buy decision is no longer about which option is cheaper. On average, it's about which risks you can realistically manage over the long term. In 2026, the right housing choice depends less on ideology and more on personal stability. Renting makes sense for Americans whose income is uncertain, whose location may change, or who value flexibility over long-term commitment. For renters, the ability to move without selling an asset reduces risk in a volatile economy. Renting can also work better in high-cost cities where ownership requires extreme leverage and ongoing expenses are unpredictable. Buying, on the other hand, still makes sense for households with stable income, long-term plans, and enough savings to handle rising costs. Buyers who plan to stay put for many years are better positioned to absorb higher taxes, insurance, and maintenance. Ownership works best when cash flow is strong enough to handle surprises without stress. The mistake in 2026 is not choosing one option over the other. The mistake is choosing based on outdated advice. Renters who expect short-term stability and buyers who expect long-term control must both plan for the realities of today's market. The smartest decision is the one that matches your financial resilience, not the one that sounds right in theory. In 2026, the rent versus buy decision in the United States no longer has a universal answer. The housing market has become more complex, more expensive, and more dependent on personal circumstances than it was in the past. Renting offers flexibility but little long-term control. Buying offers stability, but demands stronger cash flow and long-term planning. Neither option is clearly better without context. What matters now is understanding total cost, risk tolerance, and how long you realistically plan to stay put. The old advice assumed stable costs and predictable outcomes. Today's market does not. The smartest housing decision in 2026 isn't about following tradition or headlines. It's about choosing the option that protects your financial stability over time, and that choice looks different for every household. If you've watched this far, you're clearly thinking seriously about housing decisions that actually matter. If this breakdown helped you see the rent versus buy question more clearly, consider subscribing for more clear, data-driven explanations about housing, cost of living, and long-term financial decisions in the United States. And if you found this video useful, hitting the like button helps others find it too.